Remember the days of COVID when we were all sitting on old couches just desperate to spend our money on new couches and TVs? Seems like forever ago. And it was. Things are different now. We are spending more on services. We're spending more on experiences. We're spending a lot more online, and that's partly a result of what happened during COVID when a lot of retailers had to go online. And we're spending a little bit more than we were last year. This week on When the Facts Change, we go deep into the world of retail spending, the thing we call Singles Day, Black Friday, and how it compares with the good old Boxing Day. This week, we speak to Mary Jo Vergara from Kiwibank, who's got an interesting set of data on what's happened in the retail world in the last 3 or 4 years. It turns out we did buy those couches after COVID, but we're not buying any new ones. And that flat screen TV we bought in 2020 is just fine in 2024. We don't need another one. But we are spending more at the pharmacy, in part because of the reintroduction of the $5 fee whenever we collect our prescriptions. And this year hasn't been so big at the movie theatres. We find out about the world of retail, how it went this year and how it's going to go next year on When the Facts Change. Well, kia ora, and welcome to When the Facts Change to Mary Jo Vergara from Kiwibank. Lovely to see you back in the studio here on When the Facts Change, Mary Jo.
Thanks for having me. Nice to talk to you. Nice to talk and do this episode with you.
Yeah, because you've got a great new chunk of data to sort through. I'm a bit of a data geek, love a good spreadsheet. And you've got your own data on spending patterns from the cards that Kiwibank customers have. So you don't know exactly what everyone's spent and on what, but collectively you've got anonymised data, which can give you a good idea of what's happening with retail spending. And Black Friday is something we've just gone through. It's changing our retail patterns in Aotearoa. We used to be just the Boxing Day retail scene, but all of these online trends, spending habits have infected is a pejorative phrase, but filtered into our retail world. Tell us about what we're seeing with the Black Friday sales that you can see this year compared to last year.
Yeah, well, Black Friday in general has just grown in popularity in New Zealand. It comes with online retailers and also just local retailers jumping on the bandwagon. So this year when we were going through Kiwibank's data, it showed us that the total volume of spend in core retail, so excluding hospitality and food, we just want to know about retail, the total volume of spend actually increased around 4% from last year's levels, while the value of spend actually declined around 2.5%. So the value per transaction is around 6% cheaper than it was last year.
So I'm trying to work out, is that because we bought cheaper stuff or we bought the same stuff and the price had actually fallen? It seems like a weird thing to say in this age of inflation, but that prices actually fell for some things.
Yeah, I think there are two reasons for that. One of them is because of price discounting. Just over that time of Black Friday, lots of things went on sale. So the value of many goods actually fell. But also just, and also inflation just in general has cooled, especially for a lot of imported goods. They've fallen. But also I think our trolley carts look a little bit different these days. I know if we're comparing it to sort of COVID, we were buying very expensive couches and TVs, but now I think we're consuming more low value goods. And actually on a national level, we've seen that the household imports of low value goods are around 40% higher than last year. So it's the likes of Temu, that Chinese behemoth of an online retailer. They've come in and they've kind of swamped the market. So that kind of stuff I think is playing a role as well.
Yeah, so let's look through those carts at the types of things we're buying and how they've changed since the COVID days and how the advent of a lot more online shopping is changing what we buy and certainly how we buy it and how we get it. It's delivered often in a package or we might pick it up from somewhere as opposed to going to the mall. But let's look through. Online is obviously still growing. What sort of numbers are you seeing?
That's still growing. I think we've just been so used to online shopping now. And I think that's just a consequence of COVID, a structural shift really in our behavior. Many businesses had to turn to online and boost their online presence if they wanted to continue trading during that lockdown period. And I think it's just stayed with us. We're just so much used to online shopping. I know I do most of my shopping online, but that has continued to grow in terms of both value and volume of spend.
And for a lot of people, it's easier to buy online now. A lot of people have debit cards, which can be used. And then the ecosystem around phones, the Apple Pay and Google Pay is there that makes it easier. And a lot of those online outlets have spent so much time, 10, 20 years, fine-tuning their processes to make it really slippery, whoosh, straight through. Before you know it, you've spent your money, which is great, but it's certainly much easier than it used to be when we first started online shopping, where the actual act of paying the money wasn't as easy as, going in with your readies into the shop.
Yeah, dangerously easy nowadays, isn't it? You have to have a lot of resilience if you want to kind of pare back your spending. But I think just for the New Zealand economy, I think it's a good thing to have us more in the online space. It obviously opens up many local retailers to the, world as well. Whereas, previously their audience might have just been Aucklanders or whoever's around them. But now if they've got an online presence, they can go beyond their region.
Just looking at other types of spending, pharmacy is up as well as online. What's going on there?
Yeah, pharmacy was an interesting one. The value per transaction is higher than last year, but that was not necessarily because we're spending more at pharmacies, but mostly because the value of our spending had increased from last year. And I'd point that to that $5 prescription fee that's been put back in place, I think from July this year. So I think that's the reason why we've seen this big increase in the value of spend in pharmacies, not necessarily because we're spending more, but just because what we're buying is a bit more expensive.
Now, one of the themes of the last year or so has been a fall in the number of new building consents, activity in building new homes, and also a relatively modest number of house sales per month. These are existing homes. So less people, doing the whole house moving process. And that, life moment of moving into a new house is often a moment that triggers a whole range of spending. You go into the house and you suddenly realise you really hate that carpet, or the sofa just does not fit in that corner. Tell us about what's happening with home and contents spending.
Yeah, home and content spending, just furniture in general, they had the biggest fall in the value per transaction. I think because of the point you raised, Bryn, which is a really good one, how we're just seeing a very muted housing market. So there's no demand really to go out and buy a whole bunch of new furniture. Also because we did all of that during COVID. So we still have that couch, we still have that smart TV, which is smart enough for us to not have to buy a new one. So we kind of done all our consuming and our purchases then. And again, as you say, a very muted market. There's no demand for it just yet. So that is consistent with the whole weak housing market that we've seen.
Yes, there's an awful lot of 2020 vintage couches and TVs out there. Looking too at the patterns of spend through the year, as a 57-year-old man, it always surprises me at how people do things differently these days. I'm at that stage in life where it's all about the debt repayment rather than the new experiences or the new stuff. But looking at the pattern of spending, Black Friday, which feels to me like an American concept, like Valentine's Day. And then you have Singles Day, which has come out of the Chinese market, which is here as well. How soon before Black Friday, Singles Day, that October-November sales period actually overwhelms Boxing Day?
Yeah, that's a really good question because, as I said, it's growing in popularity, but Boxing Day still is the pound-for-pound champ, pun totally intended there, in terms of spending, both in terms of value and volume of spending. It's still our busiest retail day on the calendar. So maybe down the line we'll see these other more international kind of origin spending days eclipse Boxing Day, but for now, that's our biggest day. And because of that because of Boxing Day. December in total, its spend, I think, accounts for around 13% of the entire year, which is pretty big for a single month.
Yeah, and just looking at the amount of stock that shops are putting aside, you're able to see the amount of stocks and in what particular types of stores stocks have increased. What are the patterns you've seen there?
We've seen, just over the COVID period, we saw this change in inventory management where retailers went from a just-in-time kind of strategy to a just-in-case. Because of shipping disruptions, they ordered a whole bunch of goods to come pretty much all at once, but they did come at a time when demand was already quite weak. So I think part of the reason why we saw such big discounting in the last 2 or 3 years is because they've just been caught with so much stock, but they need to clear it, and to clear it, they have to cut prices, and demand's already quite weak. So some places had to cut them quite aggressively. So we've seen, I think retailers now have learnt that cutting prices obviously hurts their profitability. So they're now changing it when they're not holding as much stock anymore, and actually imports have kind of cooled off. I think they'd rather be caught with short of stock than to have so much stock and have to cut prices.
We're moving back to just in time from just in case.
Yes.
Just looking also at the types of things that we're buying, or more importantly, the types of experiences rather than things that we're buying. What are you seeing there over the last couple of years in terms of experiences versus goods?
Yeah, it's a really interesting thing. Sort of trend we're seeing come out of the data. Beyond the sort of ups and downs in retail spending, what we're seeing coming through is that Kiwi are spending more on experiences like services, going out, hospitality. They'd rather go out and buy a coffee than buy a new couch. So it's this shift in spending behavior. It could be a correction of the COVID period. Again, seems like we overconsumed during that COVID period and just on things of material nature. But now that we've been released from lockdown, we saw a lift in services spending, and that's just continued. I think people just want to go out more rather than buy material goods. And we're seeing that in spaces like restaurants and the movies and event centre and sports as well.
So tell us about movies and events, because there's an interesting story there last year versus this year.
Yes, movies and events. That was one I had an eye on, because last year we can see how these events really impact the movies and event space. And last year we had Barbenheimer, and we saw ticket sales, or movie spend specifically, just spike after that. And then now, 2024, we've had Glicked.
Glicked.
Do we know
I'm just
this?
Exposing my 57-year-oldness here. What does that mean?
Glicked is Gladiator 2 and Wicked, and it's a sort of duo and the clash for the box office crown and everything. It obviously is a worldwide phenomenon, but we've seen it here. Wasn't as successful as Barbenheimer. We saw sales increase, but just not to the extent of Barbenheimer. So it's kind of fun to watch these spending trends, because economic data is very lagging in nature. It's notorious for that. But this gives us a real-time gauge on how the consumer is doing and how the economy is doing in general.
And it does give you a feel about how people are feeling this year versus last year. Now, last year we had those very high interest rates right through the year. Things were tough. We had an election. There was a lot of uncertainty around, and consumer and business confidence was quite low. But this year we've seen from August interest rates start to fall, and 125 basis points of cuts by the end of the year. How is that flowing through into spending from the numbers you've seen so far?
I think from what we're seeing is that consumer spending is slightly improving. And I think with interest rates cuts that have come through, that Reserve Bank meeting in August was really a watershed moment. We saw confidence just improve, both business and consumer, and that's just continued. And I think from the data we've seen, it's just showing us that consumers, their ability and their appetite to spend is improving very slowly. Obviously, we've still had it pretty tough. We saw KiwiSaver financial withdrawals are still high. So it's still pretty tough for many households, and they're probably just trying to repair their balance sheets. But it does give us a little bit of confidence going into next year that it'll be a better year for the consumer and for consumer spending.
Yeah, because as well as falling interest rates, we've got inflation back down there. All of these discounts from as stores got rid of their stocks. So we're seeing for many people their incomes, shock horror, rise more than prices. So we've got some real income growth. And the theory is, along with that income growth, if you own a home, you might feel richer because the equity in your home is has increased. How important will those real income and house price gains be for retail?
It's pretty important. It's that wealth effect that you're talking about, and we know that households in New Zealand, over 2/3 of them, have their wealth tied up to the housing market. So when we see the housing market improve, that should be, good news for the consumer and consumer spending more broadly. So yeah, we're expecting a few tailwinds for the consumer next year. Interest rates will be one, real income growth will be another. Finally, we're kind of coming out of this cost of living crisis. And as well as house price gains we're expecting next year. So that wealth effect should kick in, and that should kick consumption higher in the sort of second half of next year.
Because there's another side to falling interest rates. We often present it in the media. Maybe it's because journalists and editors all have mortgages.
I think I know where you're going with this.
Yeah, but for a bunch of people, when interest rates fall, that's bad news because they've got money in a term deposit or a savings account. And I wonder if, as interest rates fall, the money that's in term deposit accounts and savings accounts and checking accounts, which is actually quite a large number, and it got quite big after COVID when a lot of people, there was nothing to spend it on, so they left it in the bank. Or maybe they got a chunk of money in COVID subsidies and they left that in the bank and didn't pay it back. We've seen, very high levels of term deposits in banks. Some of that might come back out and be spent as interest rates fall, and it's not quite so attractive just to leave it there. Is that another side of the equation, along with, people having a bit more disposable income after paying their mortgages?
Yeah, we have to think about that other side of the equation because monetary policy is a blunt instrument, and when interest rates fall, it's not just lending rates, but also those saving rates. So yeah, I think for some of our population, they'll be still quite mindful in their spending. But one good news story, I suppose, for them is that inflation is coming down, and inflation hurts those on low and fixed incomes most, disproportionately, and they don't have as much wriggle room when inflation does rise, and particularly for things like food and fuel. So that's one, I suppose, supportive factor for them next year. But yeah, we'll have this other, portion of the economy that's still kind of mindful of their spending.
And the other thing that's happening is that the lagged effect of this, 2 or 3 years of recession or near recession is flowing through into employment. And unemployment is expected to still keep rising into next year, at least according to the Reserve Bank. How much of a factor is the subdued and occasionally painful experiences in the labour market in deciding people's retail appetites?
Yeah, I think it's going to be a huge thing. I know we can talk a lot about the tailwinds for consumer spending, but rising unemployment will be a very, very big, significant headwind for them. We are still expecting the unemployment rate to continue rising, so it's a few more thousand people out of jobs. And job security is a big factor for someone's, appetite to spend. The fact that unemployment was very low during COVID, that had people spending, a lot during that period, but now we're seeing the reverse. And with job security kind of more uncertain, particularly in some regions more so than others, that'll weigh on their spending. So again, that's one factor, that maybe the recovery in consumption won't be as strong as you'd expect, more modest because of that overhang of recession on employment.
So we've got the potential for more interest rate cuts in 2025. How much more relief can people expect if they've got a floating mortgage rate and maybe if they've got a fixed mortgage rate? Because often those fixed mortgage rates don't move at the same time as the official cash rate and can be affected by what's happened overseas.
It is, yeah. Well, we're expecting another 125 basis points of cuts next year, which is pretty punchy, but we think that's exactly what the economy needs to get us growing again into 2026. our expectations aren't quite fully priced by markets. So if that does materialize, we'll see wholesale rates move lower, and that should feed on to retail rates. But you're absolutely correct. Those sort of longer end rates are influenced by what's happening overseas. And we know that over in the US, there's potential for more inflationary policy by the new presidency, and that's having an effect already on the yield curve. So I think we'll still see interest rates fall across the curve, but where they probably won't fall as far as we expected prior to Trump's election win, but as well as that, they probably won't stay as low as we expect as well. So it'll be interesting to see once, households will start to switch on to the lower rates, because we know that those floating rates and those shorter rates are the most popular right now. But I think that turning point will come very soon next year.
So 2024 has been characterised as, survive till 2025 as one way to think about things. Next year, how could we, once we've survived to 2025, what should we be thinking about? How might we feel?
I think it's going to be a year of two halves. I think we'll see a bit of the same in the first half of the year, just seeing the unemployment rate rise and, economic growth is still quite muted. But that second half of the year, once those rate cuts really do feed into households and we see the housing market start to pick up, that second half of the year should be much better. And in 2026, growing and hopefully return to more normal levels of growth. It's just the way the, economic cycles work. And we're kind of at the bottom of this one. And going into 2026, we should see a much better, brighter economic outlook.
Mary Jo Vergara from Kiwibank, thank you so much for coming into When the Facts Change.
Thank you for having me.